Today, where will property go post the election? Hello again, it's Martin North from Digital Finance Analytics, one of your latest posts covering finance and property news with a distinctively Australian flavour. Today I'm joined by Chris Bates, mortgage broker, financial advisor. Hello, Chris.
Hi, Martin. Good to see you.
Yeah, indeed. And wow, it's been an interesting ride over the last few days, hasn't it?
It's been obviously a very unexpected result. I think your listeners don't obviously know that, but if in a property sense, it definitely is it does have an impact on things. I guess what Labor's policies were and Liberals' policies are, they were completely different. And I guess it's a little bit more certainty in one direction. But, whether that certainty is forever is another question. I'm sure Labor at some point will win the election, and will they bring negative gearing policy back then in the future? We don't know. So I think it's not long-term certainty. I think it's probably just a little bit more short-term.
Well, certainly the bank shares were way up yesterday. CBA was up 8 to 9%, and most of the others were too. I guess that was a relief rally. And of course, today APRA has announced some changes to the Prudential standards. I would say a loosening of Prudential standards, and with the Reserve Bank probably going to cut interest rates a little bit down the track too. You can see a thesis that says, probably falls will probably not go down as far. At least in the short term, and perhaps more people will come back into the market. But I wonder whether this is a dead cat bounce.
Yeah, it's interesting. So I literally just saw it an hour ago, I'm sure, like a lot of people. And a lot of the work I do is obviously around borrowing capacity and understanding it. So I quickly went into some calculators and started to play around with the rules and actually the percentages and, how does this actually affect it. Now, best case in the market right now is, say, 3.5%. And that's a 3-year fixed rate, and some variable rates around that mark as well. But if you had a 2.5% on top of that, you're looking at 6% assessment rate, and currently it's 7.25%. Now, looking at some borrowing capacities, whether you're borrowing at 500 or you're earning 100,000 or you're earning 200,000, etc., it's probably going to increase your borrowing capacity by at the absolute maximum 14%, is what my numbers are saying. And that's based on minimum living expenses, and the bank's not doing too much due diligence around that. Let's say we just use minimum living expenses, about 14%. So I guess it is a bit of a meaningful impact. But I was just sitting there thinking, well, that's based on a 3.5% interest rate. Obviously, rates aren't going to stay like that forever. And so this could unwind the other way. If you link borrowing capacity to the current interest rate, what happens when interest rates go up? Well, that means borrowing capacities go down. And so while, this could be a short-term thing, if rates go up in the future, that means borrowing capacities are going to go down, and you kind of get a bit of a problem there. So, if someone's, your house is, as interest rates go up, that means people can borrow less, which means your house probably shouldn't rise as much. So it's kind of counterproductive a little bit.
Yeah, absolutely. And of course, that 3.5%, that would be the absolute best deal for owner-occupiers. If you're an investor, that rate would be quite a lot higher, wouldn't it? And it looks to me as though there's almost no benefit to property investors based on the rates that I'm seeing in the marketplace at the moment.
Yeah, I agree, because, if it's a 2.5% above the current rate, a really good investor rate now is low 4s, roughly. And so you're looking at 6.5%. So maybe that gap is probably only a 7 or 8% extra to borrowing capacity. So it's not a huge difference. And even if your loan's interest only, well, a good rate on that's say 4.5% to 5%. So you're looking at basically what it is now anyway. So, and a lot of investors will want to go interest only because they've got home debt. So I don't think it's going to make much difference to the investment market. It may to the owner-occupier market, but that's assuming that the banks aren't really going to the nth degree on living expenses. And as you know, Martin, with Westpac's case still unknown, with open banking coming as well, maybe they'll be reducing this margin, but maybe on the other side, living expenses will rise across the whole board for everyone. And so it'll kind of bounce each other out.
Yeah. Well, we know that about 40% of loans at the moment are still being compared to the HEM as a benchmark, right? Now, they are asking more questions. But as you say, if the Westpac case goes against Westpac and in favour of ASIC, then that will effectively suggest that the HEM thing will almost disappear. If it goes the other way, two comments. The first is that ASIC's already said that they will actually change the rules because they actually don't think that a benchmark is appropriate anyway in terms of prudential standards. And the only difference that I see is that it potentially will turn off retrospective class actions against Westpac or the other lenders on bad lending standards, right? So I'm not convinced that necessarily, whichever way that case plays out, it's going to fundamentally loosen the taps. It's a question of how much more it'll tighten the taps when it comes to living expenses assessments.
I 100% agree. I think it's inevitable. It's going to go down that direction. And, I guess one of the other recommendations out of the Hayne report, which kind of got lost, is that mortgage brokers' responsibility as a professional needs to rise, and it needs to go to something like financial planners, which I am as well, that it needs to become in the best interest of the customer, which is a far cry and a massive difference from where it is today, where brokers only have to recommend loans that are not unsuitable. So, or that are not unsuitable. It's just a crazy wording. It should just be what's the best interest for the customer. And so it is going to, and the documentation around that will have to be, improved upon, and will be much more diligent. And a lot of that will come around to actually verifying clients' living expenses. And so, regardless, even though, whether ASIC do it or not, I think the brokers will have a responsibility as well to go into a lot more detail. So I think actual living expenses is where we're going to end up. And, if we look at where it has been, you mentioned there about 40% are under HEM. My gut is probably the other 60% are just above HEM. And so the banks are probably still just processing loans and saying, well, they're not HEM because they're just above the HEM rate. So, I don't think that most loans are going through on actual living expenses, and the banks are verifying every dollar, I guess.
Yeah, well, I think there's going to be more rigor going forward, so I can't see any reason that will unwind. But going back to the mortgage broker point, of course, the coalition has now basically said that they won't do anything about trailing commissions for 3 years, right? And then there'll be another review. So presumably, from a broker community standpoint, the coalition win was a win for mortgage brokers.
Yes and no. I think if Labor did win from a broking point of view, the upfront commission if you're thinking about purely from a numbers point of view rather than a business growth point of view or the industry, etc., the upfront commissions would have risen most likely from probably 0.6 or 0.65% to maybe 1.1%. Now, whether the banks could have actually been able to pay that 1.1% is another question. And a lot of the banks were freaking out saying, we won't be able to afford that. It means we'll have to push up rates in the short term to claw that money back just in case a customer leaves. So I guess, technically you might think that a trial model is better, but maybe with a higher up front, it might mean businesses can grow a bit more. It also means that, they could actually put clients on, if they were providing an ongoing service, they could actually pitch an ongoing service and charge the client an ongoing fee rather than just using the trail. And so innovative companies, for my business, for example, it wouldn't have really made much difference, what way it went, because we would just restructure the way that our value proposition's built, and we get paid. So I think as a whole, the mortgage broking industry, yes, is cheering and saying, yes, we're happy. We've got not only clarity that we're not going to go to a fixed fee model, which was really CBA wanted the most. That's the model that brokers just wouldn't survived on. It would have literally decimated the whole industry. And so, brokers were okay whether Labor or Liberal really won because they just didn't want that flat fee model, because especially if it was going to get paid by the customers, because brokers would not have survived.
Sure. No, it's interesting. And in the UK, where they've gone down that route, they're still struggling with the implications of it, because basically brokers are finding it very hard to make a living. So, and some people are prepared to pay, others aren't. So in a way, you suspect that the commission formulation of some sort will remain in the industry, ahead. Another question then is, given what you've seen and given the results in the election and what's going on in the marketplace, what's your sense in terms of, property prices? Because they've drifted down, in Sydney, they're down 10, 11% on average over the last 12 months. Do you think this is enough to sort of turn that around, or do you think we're still going to see, continued grinding down over the next couple of years, say?
So I always go back to demand and supply, and I think it's always boring and things like that. But if you start from that basis always and you think about it, the property market also runs on confidence. And, confidence has been severely hit over the last 12 to 18 months. And, people aren't just going to actually get competition, to actually get, sustained competition over many months and to actually create a pressure cooker. We're really going to need a shortage of supply hitting the market. And we've got more supply on the market than ever, and we've got very few buyers coming in. And so unless buyers feel this kind of fear of, missing out really, and this fear of, if I don't catch it now, I won't catch it, they're not going to rush back in. And so it's going to take a long time for that pressure cooker to start up. And so what my worry is that, supply and people listing property is going to be a lot more than people entering the market. And for some time, especially in the outer suburbs, house and land packages, your rural area, high-rise apartments, etc. I think supply is going to outstrip demand for so long, and I can't see anything turning around to those markets. In areas where there is very little supply, so you might see more supply on the whole market of Sydney, but if you look on the inner ring suburbs, on good streets, things that suit families, there's very little supply on now. It's actually a lot lower than it was, and you can see that in the auction numbers, how many auctions there are, and because that's usually a lot of generally better property as well. And so my gut is that we're going to see very little supply in these markets anyway hitting the property market. And it wouldn't take too much in those markets to create a little bit of competition, but I'm talking just very scarce assets, because there's literally a handful of decent properties right now in the inner west where there might have been 30 or 40 on the market. So you only need 10 buyers out there actively pursuing these to create a little bit of competition and to create floors. So everything else, though, I would be very pessimistic on still, and I don't think this is going to change, because a lot of properties are bought by investors, and investors aren't coming back because this isn't changing their borrowing capacity. And investors have been scared around interest only. They thought it was a given. You could always get interest only. You could always refinance. You could always just get another 5 years. All the investors out there have been scared for the last 2 or 3 years, thinking we're not going to be able to refinance our interest only loans. And so they're not going to just rush back in and just gear up to the nth degree, because A, they can't, and B, they're too scared.
Yeah, interesting. And so with regard to property investors specifically, because I watch that sector of the market quite closely through my surveys, I'm not seeing any great appetite for investors to come back into the market at the moment. And, the rental flows are getting tighter. Rentals in Sydney have dropped 3%, in the last quarter, I think. And the number of households with investment properties where the rental streams are dropping, the costs of the mortgage are rising, mean that about 60% of property investors across the country now are actually on a cash flow basis in negative terms, right? So I think there's becoming a greater urgency potentially for some of these investors now to think more seriously about whether they should continue to hold investment properties. And my sense is that there may be a little bit of sales activity from the investment quarter into maybe a little bit of demand from some other sectors, but there will be a lot of investors who will still try to get out and won't be unable to get out. And that means that we've got a big issue, not just for now, but for later. And it's interesting that comparing the proportion here in Australia, there's about 34% of properties are investment properties. In Ireland, before the crash there, it was half that. It was about 16%. So we still have a huge overhang in the investment sector, and I can't see that is going to actually work its way out anytime soon.
Yeah, I agree. There's not a supply shortage of 2-bedroom, 1-bedroom units, and we're building another 100,000 of them at the moment. So, and the developers have bought lots of land they're wanting to build more 1 and 2-bedroom units, and we're building all the wrong type of housing stock. The stock that we need is actually things that suit families, that people want to build families, around and grow into as a family. And that's just not really what we're building. And yes, we're building them out in the outskirts, but there's a problem with, if there any shock to interest rates or unemployment, and there's more and more house land packages hitting the market. And this is a really interesting point that I've kind of been watching, is the price of these buildings in house and land packages is much, much cheaper now. You just have to flip open the paper on a Saturday there's $80,000 off a build, live rent free for, your mortgage for a year. There's all these deals that are coming on. And I think a lot of the builders are basically just buying loss-making work just to keep their business running and keep all their good talent. So when there is a potential boom in the future, they haven't got to go and try to find all these builders. They've already still got their staff. And so they're just kind of, saying that we're not going to make much money in the next few years. We just want to keep our good talent. And so they're just buying work. And, I think the 5% Morrison thing, I know you've done probably a lot of talking about that already. I think it's absolutely crazy. Out of the mortgage broking industry, I'm probably the only voice there, but I think it's absolutely stupid to be putting people into 95% loans who have got zero savings and taking the biggest risk, because that's what it is. And, generally the borrowing capacities and what they're buying is generally poor quality properties just to get in, which has got the biggest risk of going down. So I think you're basically stitching up the next generation. And I just see it like a credit card. You're bringing forward future buyers who aren't ready to buy now, and you're saying just buy now because you can. And I think it's when I first heard it literally, I was in the car driving back from Mother's Day, and I heard it, and I was screaming, and it just reminded me of George Bush in 2002. This great American dream, buy property. And I was like, come on, guys, it's you need to care about people more than this. And just owning a home doesn't mean that everything's okay. You're actually risking their future.
Yeah, well, I've discussed this particular incentive scheme quite a lot over the last week on, 2GB and elsewhere on the ABC, because to me, it really makes no sense at all. It will lure people into a situation that they should never have got into. And if prices do drop 5%, they basically have no equity. And of course, the serviceability has to be assessed on 95% anyway. So those are still going to be big repayments. And I guess it shows a little bit of a sense of, people will do anything to try and keep the bubble alive. But actually, keeping the bubble alive is not necessarily strategically the right sense, particularly in a situation where our economy is beginning to look a little wobbly, and I'm thinking particularly of employment. So I'm watching those employment and unemployment statistics now, because my feeling is that they're going to go up over the next 12 to 18 months. And certainly it's one of the biggest impacts in terms of ability to be able to service the mortgage. If you're out of work, then you can't. So if the employment rate starts to change and unemployment starts to rise, watch for some higher levels of default ahead.
I mean, I guess they're really just kicking the can down the road and not actually dealing with, the realities, and just saying, look, we've got to get through this housing, deflating the market basically, and we've got to work on wage growth. And if we have to reprice our property market over the next, say, 5 to 10 years, that's just what we need to do. And, and I guess in any government, they want to keep the economy going, and housing is just such a big part of the economy. Stamp duty, people moving in, furniture, and the list just goes on. The flow-on effects of property transactions has a huge impact in our market, and I guess that's what the government want to do, is just keep bringing that money in and keep the wheels turning. But personally, I think it's just a stupid idea just to keep on, because if there is a bit of a shock to the world, and China and America and whatever we want to call it, it's going to happen at some point. This is just the reality. Is, do we really want to be in more and more debt and creating a bigger and bigger problem? And I think that's the direction we're going in again.
Yeah, it does seem like that. But of course, the argument is also that at least the local government here and the Reserve Bank can blame international crisis for the problem, right? Whereas in fact, at the moment, they've got no plausible deniability, because it's actually their own policies that are actually creating the situation here. So my theory has been for some time that they will try and keep the bubble bubbling along, and hope that eventually, if it goes wrong, it goes wrong from an international perspective, so that they can blame China or the US or Brexit or anything, but not their own policies. So I suspect that's actually part of the behaviour that we're seeing.
Yeah, and I guess they want something up their sleeve to say, look, we tried, and so you would probably see rates go to 0 or 0.25 or whatever they can legally do. I'm not actually sure where they can legally go to. But, I guess that's the first thing. And then they'll probably try something to, improve bank funding and, some type of quantitative easing and things like that. But, there's not that much they can really do when confidence is fearful. And I guess that's my biggest observation with the market is, when the market is falling and people are less likely to buy and invest. When the market is rising, that's when investors think, oh, I should rush in. And so, it's going to take a lot for people to switch from markets falling, property prices are falling, to it's boom time. And more likely what we're going to see is, yes, there's probably some floor at some point in good areas, but that doesn't mean the prices are going to jump up and you're going to go up 15, 20% and go back on another boom. We're more likely to see what we did between 2003 and 10, 12 in Sydney, where things didn't really do that much. And it wasn't until wages started to outstrip and renting got a bit more expensive and people said, hang on a sec, I should actually start to buy property, and rates went down. So, I'm more likely to say, even if we do see a bit of a floor, it doesn't mean markets are going to boom again.
Yeah, I think that's exactly right. And so I think, in summary of what we can say is, while there will be incrementally, some things around the edge that will actually perhaps, stop the falls being perhaps quite so severe, nothing has fundamentally changed. We've still got the very high debt levels. We've got very high house prices. We've got flat incomes. We've got rising costs. And there is a limit to what can be done. So therefore, the probability is that we're going to see things go sideways or down or something like that. And I'm conscious of Japan as an example of an economy where prices for a long, long time have done absolutely nothing. And if that's the situation that we find ourselves in, even that would be a remarkably different environment from the one that we had a decade ago.
Yeah, I guess with Australia, and I know that a lot of your listeners, are probably a bit unsure about how population plays into this, etc., and the impacts of that on the market and things like that. And if I say that the reason property prices are going up is and long term will be down to population and things like that. But fundamentally, if you do increase, say, the population of Sydney, say 50% over the next whatever period, or 30% or 40%, and we do have no more properties in the inner rings where most people want to live. That's, when you think about prices and, population growth, there probably isn't a story there. But my theory is that what we've been building and this type of stock and the cheapness and the poor quality stuff that we keep on building, I can't see anything that really make that desirable, and really will be what people really want long term. I actually think we've built really poor property and poor assets that are just going to lose value, and there's not going to be a turnaround point. And so if I owned a very bog standard high-rise unit that had nothing special about it, there's no turnaround. There's no going back to where things were. You really need to not own these type of assets, and if these are house and land packages in the outer suburbs. The only reason the house and land packages of the 80s and 90s are now worth a lot of money is because they're on 600 square metre blocks or 800 square metre blocks, and they're 20 k's from the city. Now we're talking 350 square metre blocks at best, and they're 50 k's from the city. So it's going to take a long time for these properties to see anywhere near the type of growth that old greenfield sites did 20, 30 years ago. And we can't go from one worker families to two worker families. We can't go from, very low incomes to potentially two high incomes. So I think, if you're owning property, you've got to really question whether it's really going to make sense long term. And that'll really determine on, really the scarcity of it.
Absolutely. Yeah, well, I think it sounds as though we're in for an interesting ride ahead, but not necessarily a reversion to what we've seen over the last, 10, 15, 20 years. So people need to be way more cautious. I think personally that they should be very careful if they're going to commit to very large mortgages in the current environment, because the chances are that this is going to be quite a different environment ahead. And whilst we might see some stimulus around the edge, it doesn't fundamentally bring us back to where we were, then. New world, new norms, and the new normal is much less positive for property.
Yeah, especially if we are going into a low interest rate, stuck, low inflation, low growth, low employment, low wage growth. Then you might actually just think, and especially with renting as well, you look at the price of property, if income isn't going up, can rents go up? And and so that's the reality. So if, that makes the whole rent versus buy question more on the table, because if you can rent at low yields, and those rents are likely to stay low, why would you go and buy? And I think a lot of people should be thinking like that, because the solution isn't always just to buy. And, that's been what's been drilled into you as a child, as a teenager, as a parent. That's what Scott Morrison wants you to think. But maybe it's not the right decision for some people. And I think, it's not just, buy property, pay it off, and, everything could be okay. And I think a lot of people should be thinking like that, rather than just assuming that they should just go and buy a house and just to get on the market.
Chris, I really appreciate your time today, and I think that's excellent advice. Thank you very much indeed.
Thank you, Martin.
Okay, good to talk to you. So there you have it. Very interesting perspective from Chris there. And I think he's absolutely right that there may be some short-term momentum, but actually the long-term fundamentals mean that property is still overvalued, that we expect to see more home price falls ahead. And therefore, people who enter the market now must be really, really careful. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.